1 ounce of gold. How many ounces of silver does it take to buy it right now? The answer is up in the high 60s. Almost 70 ounces of silver for 1 ounce of gold. Hold that number, because that one number is the whole video. And here is why it matters to you, not in some abstract way. If you own silver right now, that single number is quietly deciding whether the metal sitting in your account is cheap or expensive, not against the dollar, against gold, which is a different, older, and far more revealing question than the one everybody else is asking. There is an entire industry on this platform built on grabbing that number, waving it in your face, and promising you that the day it snaps down to 40, silver rockets to $103 an ounce. You have seen the thumbnails. Big red arrow. Snap it to 40, silver hits 100. And almost never one single line of arithmetic underneath the shouting. So here is my promise to you for the next few minutes. You and I are going to build that $100 case together, one honest step at a time, using nothing but division you could do at your own kitchen table. By the end, you will be able to run it yourself. And this is the part that actually matters. You will know exactly which step of it is solid ground and which step is a leap of faith across a canyon. You will never have to trust a thumbnail again, because you will be able to check its work. And there is one thing about this ratio that the people selling you that $100 number will never, ever put on the screen. It is not a price. It is the reason being right about this ratio can still cost you years of your life while you wait. It is the thing that decides whether the reversion everyone is promising you ever pays you a single dollar. I am saving it for the very end, because it is the honest other half of this entire story, and it is the part nobody else will show you. Stay with me, and you will have it. Now, before we touch a single silver number, I want to take you back, because the reason this ratio is worth watching at all is not a theory somebody cooked up for a thumbnail. It is a thing that actually happened, inside the working life of one ordinary man. Picture a fellow who ran a little coin shop. Nothing grand. A glass counter, a scale, a loop on a chain, a bell over the door. He is the kind of man a lot of you know, because a lot of you are him. And in the early part of 1980, at the wild peak of the Hunt brothers cornering the silver market, he stood behind that counter and watched something he would remember for the rest of his life. 1 ounce of gold, in those weeks, traded for as few as 17 ounces of silver. 17. Silver was so expensive relative to gold that you could hand over a small handful of silver ounces and walk out with gold. He had customers lined up out the door selling their grandmother's flatware, their old coins, anything with silver in it, because silver had gone vertical and the ratio had compressed to a level almost nobody alive had seen. Now walk that same man forward with me about 11 years, into the early 1990s. Same shop, same counter, same bell over the door, and he watches that same ratio do the exact opposite. 1 ounce of gold now buys him around 100 ounces of silver. 100. The exchange rate between the two metals had swung from 17 to nearly 100, roughly 6 times. Same two metals, same vault in the back. Nothing about silver the element had changed. Its atoms were identical. And yet the number of ounces it took to buy an ounce of gold had exploded almost 6-fold in one man's career behind one counter. Sit with that, because it is the foundation of everything the $100 crowd is trying to sell you, and they almost never tell you the honest version of it. That coin dealer learned something standing there that most investors never learn in a lifetime. He learned that the ratio is not a fixed thing. It is not a law of nature. It is elastic, it is emotional, and it swings across an enormous range. It has been down at 17. It has been up near 100, and when it is stretched wide, silver is historically cheap against gold, and when it is compressed tight, silver is historically dear. He stopped watching only the dollar price of silver, the way the man on the news watches it, and he started watching the tide running between the two metals. That is the whole secret of this number. And right now that tide is sitting up in the high 60s, which is a long, long way from the 17 he once saw. So let me put today's picture on the table plainly, because the daily tick does not matter, and the shape does. Silver has just come through a hard shakeout. It got knocked down into the mid-50s, a fast and genuinely ugly flush, its lowest in the better part of a year, and then it clawed its way right back up above 60, recovering much of that drop in a matter of days. If you held it, you felt both halves of that, and I am not going to pretend the down half was any fun. Gold, meanwhile, barely flinched. It pulled back only modestly and then rallied back over $4,100 to a multi-week high, calm as you like, while silver was throwing itself around. And that gap, a small gold wobble against a violent silver swing, is exactly why the ratio pushed up into the 70s during the panic and has only eased back into the high 60s as silver started to outrun gold on the way up. Still stretched, still historically wide, just beginning to close. So where does that $103 number actually come from? Not from a shout, it comes from pure division. And I'm going to walk it with you right now, slowly, the way the analysts who do this for a living actually build it. The ratio is just gold's price divided by silver's price. That is all it is. So flip it around. If you take gold's price and divide it by the ratio, you get silver's price back out. That means if you have a view on where gold sits and a view on where the ratio goes, the silver price falls right out of the arithmetic. There's no magic in it. It is a fourth grade word problem. Gold is sitting a bit above $4,000 right now. Take that 4,000 and divide it by the ratio where it sits today, up in the high 60s, and you get silver right about where it actually trades, back above 60. Good. The math works on today's numbers. Now, the only question left is what happens to that ratio? Because gold is the number you can more or less see, and the ratio is the variable. So watch what happens as you compress it. Take gold, hold it right where it is, a bit above 4,000, and ask what silver would be if the ratio snapped down to 40. That is the number in every thumbnail. 4,000 and change divided by 40 lands you into the low three figures, right around $100 an ounce. There it is. That is the entire $103 case in one line of division. Snap the ratio to 40, hold gold where it is, and silver is 100-something. Not because anyone waved a wand, because 40 into 4,000 is 100. That is why they can put it on a thumbnail. The arithmetic itself is airtight. And it does not stop at 40. Keep compressing. If that ratio went to 30, which it has visited in the modern era, that same gold price divided by 30 puts silver up into the neighborhood of $130-odd. And if it went all the way to the 17 our coin dealer watched in 1980, 4,000 divided by 17 lands you well over $200 an ounce, up toward a couple $150. That is where the bolder targets you have seen, the 250-ish numbers, actually come from. It is not a random guess. It is 1980's ratio applied to today's gold. And go all the way to the old 15-to-1 that held under bimetallism for centuries, and you are pushing right up toward the 300 that the boldest bank bull cases quote. Every one of those scary numbers is just this same division with a smaller ratio plugged in. And that is exactly the moment I need to stop and talk to you directly. Because this is where a real decision quietly sits, especially if you are the person this channel is truly for. If you are sitting on $100,000 or more in a retirement account, a 401k, an IRA, something you spent a working lifetime filling up, then a setup like this one is precisely where the choices you make actually count. Because a metal this volatile is going to test you, and the difference between owning the real thing and owning a paper promise on it turns out to be the whole ballgame. I put together a free retirement protection guide for exactly this reason. It lays out in plain English how some retirees are moving a portion of their savings into physical gold and silver without triggering taxes or penalties, held inside the tax-advantaged account they already have, metal they actually own, rather than a number blinking on a screen. If you are watching this on your TV, just scan the QR code on your screen. If you are on your phone or your computer, go to jeffreedguide.com. And if you read it and want to talk it through, there is a free, no-obligation, one-on-one educational session for folks with $100,000 or more in any retirement account. No pressure, nothing to buy, just answers. jeffreedguide.com. Now, back to the ratio, because we have built the case, and now I have to show you where it is soft. Because here's the part that actually changes things, and almost nobody selling you the number ever gets to it. So let me shift gears and be blunt with you. The division is airtight. The division is not the question. The division was never the question. Every single one of those targets rests on two assumptions hiding underneath the arithmetic, and they smuggle them past you every time. Assumption 1, gold holds where it is. Assumption 2, the ratio actually reverts. And neither one of those is division. Neither one of those is a fact. Both of them are forecasts wearing the costume of a calculation. Look at the first one. The $100 case assumes gold simply sits still at 4,000 something, while silver races up to close the gap. But gold is not nailed to the floor. Gold could fall, and then your $100 silver number falls with it, because it is gold divided by the ratio. Or gold could keep climbing, which would actually push the silver target higher. But the point is, you are quietly betting on gold too, whether you realize it or not. The people flashing the silver number never mention that half of the trade at all. And the second assumption is the big one, And this is where our coin dealer comes back, because he lived the answer. The whole case depends on the ratio snapping down from the high 60s to 40 or 30 or 17. And here is the brutal truth the thumbnails bury. The ratio can stay stretched for years. Years. Remember, our man watched it sit up near 100 in the early 90s. It did not snap back to 17 the next quarter to reward the people who noticed silver was cheap. It stayed wide and it stayed wide. And anyone who bought silver calling it cheap at a ratio of 80 in the late 80s had to sit there, correct and unpaid, through a long stretch of nothing while the ratio refused to cooperate. Cheap relative to gold is not the same thing as about to go up. A stretched ratio is a value argument. It is not a timing signal. It does not come with a date, and a few days of silver leading gold on a bounce, like the one we are watching right now, is not the reversion arriving. It is a flicker, not a turn. So when a growing number of analysts make the case for triple-digit silver, and some banks sketch out bull scenarios running up toward the low 300s if the physical shortage keeps deepening, understand what that is. It is a real argument, built on real division and a real historical range for the ratio. But it is a case, not a promise. And every honest voice attaches those two soft joints to it, the gold assumption and the reversion assumption, right out in the open, where you can see them. And I have to say the next part plainly, because you are going to run into it out there, at the far edges. There are voices calling for $1,000 silver, or $50,000 gold, or some clean 30-fold multiple. I am not going to insult you by pretending those come from the same place as this ratio math. They do not. Those numbers come from imagining a full monetary reset, a dollar rebuilt from scratch on the gold sitting in the vaults, and then applying an old ratio to that reimagined world. It is a story about the end of the financial system as we know it, not about next year. The bigger the number, the more it is assumptions stacked on assumptions stacked on assumptions, and the more skepticism it has earned from you. I lay out why those people argue what they argue so you can see the whole spectrum, not because anyone alive can hand you that number or a date it shows up. Which brings me back to the coin dealer, and to the one thing I promised you at the very top, the thing that matters more than 103 ever could. Here is the honest truth, and I want it to land because I cannot say it often enough. I cannot promise you a price, I cannot promise you a date. And the very second anyone does promise you either one, you should close their video and never go back, because they have just told you they are not on your side. Silver is the most violent major metal there is. It overshoots wildly on the way up and just as wildly on the way down. You just watched it flush into the mid-50s and snap back above 60 in the span of days, and it can turn right around and do the ugly version just as fast. It could stay cheap against gold for far longer than you think you can stand. It could fall back below where it just broke out before any of this case ever plays out. And even if every one of those analysts turns out to be dead right about where it eventually lands, the road there can take years, and it can be brutal enough to break your conviction at the worst possible moment. That is the thing the ratio never shows you on a thumbnail. The ratio at 100 in 1991 told you silver was historically cheap against gold. It was right, but it did not tell you when, and it did not tell you how much longer you would have to wait, and it did not tell you how many people who correctly spotted that cheapness got so tired of waiting that they sold out right before it finally moved. Being right and being early feel exactly the same while you are sitting there holding. They feel identical, and only one of them ever pays you. That is the honest other half of this whole ratio story, and it is the part nobody flashing 40 and 100 will ever put on your screen, because waiting does not fit on a thumbnail. So understand what actually moves this in the short run, because it is not the ratio and it is not the deficit. In the short run, silver answers to the Federal Reserve, which under Kevin Warsh has turned hawkish, with a rate hike on the table instead of a cut. And metal that pays no interest always struggles when rates threaten to climb. It answers to the dollar, it answers to fear, and to whatever the paper market feels like doing on a given morning. The stretched ratio and the shortage under it, those are the long, slow trend. The Fed and the dollar are the weather. And the weather can soak you for a long, long time before the trend ever shows up at your door. So here's what to actually do with all of this. And it is not advice. It is just how a calm person thinks about their own position. First, own the metal, not the promise. If the ratio ever does snap and silver runs, the whole difference between the people who get paid and the people who get wiped out is whether they held the real thing or a leveraged paper claim on it that someone else could yank away at the exact wrong moment. Second, size it so a further drop cannot force your hand. If silver falling back below where it just bounced would force you to sell at the bottom to cover a bill, then your position is too big, no matter how airtight the division looks, because being forced to sell in the valley is how right people still lose everything. And third, never sell into the shakeout. The shakeout is the machine that transfers metal from the people who feel to the people who own. Do not be the fuel. If you are on your TV, the QR code is on your screen one more time. If you are on your phone or your computer, go to jeffreedguide.com. It costs you nothing to be informed. And the honest reason to look now is not fake urgency. It is the plain fact that the time to think a decision like this through calmly is exactly when nothing feels urgent, which is right now, not the day everyone is panicking and the good options have already closed. And for those of you who stayed with me all the way to the end, here is something just for you. If you have $100,000 or more in any retirement account and you mention that you watched this full video, you can claim a free one-on-one, no-obligation educational web conference. A real conversation about what you actually own versus what you only think you own. No pressure and nothing to buy. That is for the folks at that level who made it all the way here, and you are one of them. jeffreedguide.com. So, could this video sit under some other title? No. You came to find out where Snap It to 40, Silver at 103 actually comes from, and now you have it, built with your own two hands. It comes from one line of division, gold divided by the ratio, and from a ratio that history proves is elastic enough to have lived at 17 and at 100 inside one man's career. The $100 case is real arithmetic, resting on two honest assumptions, that gold holds and that the ratio reverts. It is a genuinely strong case. It is not a promise, and anyone who hands it to you as a promise, with the two assumptions hidden, is not on your side. And that coin dealer behind his glass counter, the one who watched the ratio run from 17 all the way up to 100, he told a younger man years later the only thing worth remembering out of all of it. The number, he said, will always tell you which metal is cheap. It will never once tell you when. So do not fall in love with the target. Fall in love with surviving the wait. The 100 may come and it may not, and no honest person can tell you which. But set your life up so that you are still standing, still holding, still calm on the day the tide between the two metals finally turns. Because the ratio rewards exactly one kind of person, not the one who was right, the one who was still there.